现在整个金融圈主打就是一个节俭。
The financial industry is currently focused on frugality. People used to think that finance professionals always frequented five-star hotels and flew business class. But now, with shrinking salaries, luxury spending is no longer possible. For accommodation, 400 yuan per night is the norm in first-tier cities, but finding that price in Shanghai is nearly impossible, while in second-tier cities, it's down to 300 yuan. When meeting potential partners for a meal, people now opt for simple nearby meals instead of lavish gatherings. In the past, it was common to have large group dinners, but now the fewer the attendees, the better, keeping things affordable. Where people once paid for streaming plans, some office colleagues have switched to watching short episodes that cost just a few cents per episode. Even digital products are not upgraded as often. For example, our investment manager still uses an iPhone 12, and my computer is 4 to 5 years old, slow but still functional, and I don't feel like replacing it. Overall, the financial sector has become more modest. Flaunting luxury watches and cars is no longer common.
The Chinese stock market has been in a prolonged downturn for years, essentially with no recovery in sight. This has led to a significant decline in the performance of securities companies, and their employees are facing pressure from salary cuts and layoffs. The overall trend of downgraded consumption has set in, with tightening belts becoming the new normal. Once known for their impressive incomes as corporate emperors, securities employees have now become financial laborers. Working in the investment bank division of a top securities firm, Ye Jia is adjusting to a low desire lifestyle of saving where possible after years of not worrying about prices. On a Friday night, she invited a few friends over to her living room. The table was set with a few simple dishes, costing no more than 40 yuan. This simple life fits well with the atmosphere of her old Shanghai neighborhood in Pudong. The buildings here were constructed in the 1990s, 6 stories high, without elevators. The rent is affordable though. For 7,000 yuan a month, one can rent a 3-bedroom apartment split between 3 people, which isn't too expensive. In comparison, around the Oriental Pearl Tower, 7,000 yuan only covers a 1-bedroom apartment. In the financial world, compared to the employees in banks and insurance companies, securities firms and investment banks sit at top of the pyramid, attracting the brightest talent from top universities. Like many financial elites, Ye Jia has an enviable resume. She is from Zhejiang, studied finance at a prestigious university, and later went to France for her master's degree. After graduating in 2018, she returned to China and became a researcher at a domestic securities firm. Her company is located in Shanghai's financial hub, Lujiazui Financial District, which houses over 8,000 financial institutions. In her 6 years in the industry, she has witnessed a brief A-share bull market, enjoyed the perks of a high salary, and felt the downside when things slow down. Securities companies typically earn revenue from several sources: brokerage services, asset management, investment banking, and proprietary trading. Before 2019, brokerage services were the primary income source for the industry. Yi is responsible for asset management with a monthly base salary of 30,000 yuan. When the market is good, her quarterly bonus can range from 100,000 to 150,000 yuan. She mentioned that during strong periods in the A-share market, sales staff with 4 to 5 years of experience could earn 300,000 to 500,000 yuan annually, with Million-Yuan salaries not being uncommon. High consumption among securities employees was also widespread. Back then, Yi never took the subway and dined at Western restaurants where the average meal could cost over 200 yuan per person. Even her roommate remarked that they only choose expensive places because the company reimbursed their expenses. In those days, everyone in the industry lived quite comfortably, renting expensive apartments with annual spending on rent reaching into the tens of thousands. Luxury purchases were common, with at least 100,000 yuan spent annually, and occasional domestic and international trips. Spending 500,000 yuan a year was entirely normal. However, high salaries inevitably come with risks and pressure. Yi explained that her clients are institutional investors, different from retail investors who might invest hundreds of thousands to millions in the stock market. Institutional clients deal in tens of millions or billions, and when large losses occur, she cannot avoid the consequences. In other words, Yi Jia's interests are closely tied to those of institutional clients. When they make profits, her company earns, and she shares in the rewards. But if her reports contain significant errors, it leads to massive losses, affecting both the company and herself. Ultimately, the accuracy of her analysis relies on experience. Yi mentioned that the bonuses they rely on are typically distributed at the team level, with senior management having the power to allocate them. However, under current regulations, employee salaries are not directly tied to the revenue generated by the projects they manage or undertake. Now that senior executives are seeing their bonuses cut, it's inevitable that others, like herself, are also affected. While 2023 saw a reduction in bonuses, this year has seen a dramatic decline in income. Just 2 years ago, Yi maintained a busy and fulfilling work schedule, with her salary steadily increasing. Like many in the securities industry, she hardly worried about money. Every 3 months, she would receive a bonus substantial enough to cover the down payment on a home back in her hometown. She explained that when the market was booming, money flowed easily, leading to a habit of high spending. This included purchasing luxury brands just to complete an outfit or buying property at peak prices, even with high mortgage rates, just to stay in the big city. However, this lifestyle only lasted until mid-2022. In the second half of that year, with the introduction of salary caps and new regulations like the temporary tightening of the IPO approval process, securities firms began cutting costs and increasing efficiency. A series of pay cuts followed, and many people in the industry accustomed to a high-spending lifestyle struggled to adjust. Now Yi Jia has switched from taking taxis to riding the subway, and instead of dining out at Western restaurants, she buys simple dishes from local delis. Even her office supplies like pens have changed from imported brands to domestic ones. With fewer client meetings, Yi now rarely wears business attire since there isn't such a need to be meticulous with her appearance. Her company is the same. She noted that leadership has said that with declining company performance, everyone needs to tighten their belts. Even expense claims are now tightly controlled. With most of 2024 already gone, Yi still hasn't received her bonus from last year. She predicts that if things continue this way, she might not be able to stay in the industry much longer. The once prestigious Golden Rice Bowl of the securities industry seems to be fading, leaving employees with a tough choice: change careers or stick it out. Some of Yi Jia's colleagues have chosen to sell their homes and leave the industry, and others have resorted to more extreme ways to escape the pressure. One of her friends is preparing to leave Shanghai and return to their hometown, having saved some money after 5 or 6 years of hard work. They plan to find a more stable job back home. Another friend has resigned and moved overseas, where they say wealth management in US dollars offers commissions of up to 20%, making it easy to earn 1 to 2 million a year. Others have advised Yi Jia to quit, take a break, and use the time to reflect and wait for better opportunities. For now, she is still observing, and luckily, the money she worked so hard to save gives her the luxury of time to make a decision. Amidst this market downturn, many people in the securities industry like her have had to adjust both their work and lifestyle choices. Another top securities firm employee, Zhao Lu, who has been working in this investment banking division for 4 years, also experienced great success a couple of years ago. Back then, she too almost always opted for taxis. If asked how much it cost to take a taxi from home to work, she wouldn't have known. But now she always chooses public transportation whenever possible, and even when taking a taxi, she prefers to share rides. In the past, she would buy whatever she wanted without paying much attention to the price, but now she eats at home whenever she can, and when dining out, she sticks to meals costing less than 100 yuan. Coffee is still essential for her, but she switched from Starbucks to the domestic brands like Luckin Coffee. Luxury brands have all but disappeared from her conversations with colleagues. Despite several salary cuts, Zhao Lu believes that adjusting her lifestyle offers only minimal relief. For high-income earners like her, the bigger impact lies in the reduction of capital investments and the use of leverage. She once had plans to buy a home after working a few years, taking out a mortgage, and says that her previous salaries could actually support buying a home and making monthly payments in a first-tier city, but now she has completely given up on that idea. Zhao concluded that people are generally moving towards deleveraging because cash flow has become uncertain. She thinks this is more evident among finance professionals, as they all work in this field and know how to calculate risks, so overall they are becoming more cautious. The securities industry relies heavily on market conditions, often described by the saying, 3 years without business, but 1 good year can sustain 3. However, since 2021, the stock market has experienced ongoing declines in volatility, resulting in low investor enthusiasm. This, combined with a slow pace of IPO issuances, has led to growing anxiety over revenue growth within the sector. Zhao reflected on how, during good market conditions, people had many aspirations and plans for their lives. However, she noted that a sudden realization had set in, that market trends were not as objective as once thought, and the future was difficult to predict. This left many financial professionals feeling as though they were passively enduring the challenges of the times, where even small problems could feel overwhelming. The anticipated post-pandemic economic recovery had not materialized, disappointing many. According to financial experts, investors were beginning to realize that the high levels of economic growth seen in the past would be difficult to achieve again. Zhao explained that commissions were their primary source of income, and as economic activity slowed down and people reduced their spending and investment, the financial sector's earnings naturally shrank. She believed that even without government intervention, the industry was unlikely to see the rapid growth it had experienced in the past. The sharp salary reductions in the financial industry, combined with plummeting property prices in the financial district, signaled a looming crisis. Cost-cutting measures in the industry had become so extreme that stories circulated about firms eliminating paper towels in restrooms, replacing bottled water with paper cups in meeting rooms, requiring managerial approval for color printing, and reducing travel and dining allowances. Data from the China Securities Association showed that in 2021, the securities industry achieved 502 billion yuan in revenue and 191 billion yuan in net profit. By 2022, these figures had dropped by nearly 100 billion yuan in revenue and over 50 billion yuan in net profit. In 2023, the sector saw revenue increase, but without corresponding profit growth. The downward trend persisted into the first half of 2024, with over 80% of listed security firms experiencing performance declines. The struggling economy and weak capital markets forced many Chinese securities firms to cut their workforce. Public data from the China Securities Association revealed that by the end of June, the industry had reduced its total workforce by more than 10,000 people, representing a 3.4% decrease since the beginning of the year. Founder Securities, CITIC Securities, and Gosen Securities were among the firms with the highest staff reductions, each cutting around 700 to 1,000 employees. Speaking about the widespread salary cuts across the securities industry, Tianli Hui, Dean of the Institute of Financial Development at Nankai University, mentioned in an interview with China Newsweek that the primary reason were the proactive, cost-cutting, and efficiency-boosting measures driven by policy, the passive decline in performance due to market changes, and the adjustments in compensation systems amid heightened competition. As of the end of August, major Chinese listed securities firms had released their half-year reports, revealing trends in personnel turnover and compensation. Leading firms such as CITIC Securities, CSC Financial, China International Capital Corporation, and Huatai Securities all reported declines in total salary expenses for the first half of the year. An employee from one of these top firms noted that, due to tighter IPO policies and fewer listings, performance bonuses related to IPOs had nearly disappeared. The financial industry, led by securities firms, once stood out for its high income, creating a wider gap with other sectors. In 2021, the average annual salary at CICC reached 1.16 million yuan, making it a leader in the industry. People used to jokingly refer to them as money printing machines. During the same period, the average annual salary for employees in large Chinese companies was 88,000, while workers in urban non-private companies earned an average of 106,800, and those in private urban companies earned 62,900 yuan. In 2022, CICC's average payable salary dropped to 819,600 yuan. In 2023, it further declined to 700,400. This trend of salary reductions has shown no signs of stopping, continuing into 2024. Online data shows that in the first quarter of this year, CICC's average payable salary had decreased to about 105,000 or 35,000 yuan per month, representing a 64.5% decline over 4 years. A significant turning point for the industry came in July 2022 when the wife of a CICC employee posted a wealth flaunting photo on social media, showcasing her husband's monthly income of 82,500 yuan. This sparked widespread controversy. Analysts believe that the incident caused such an uproar because many ordinary people's incomes have been significantly affected by the pandemic. The flaunting post not only fueled anger towards the CICC employee's family, but also ignited public resentment towards the entire financial industry. During a period of general economic hardship in China, the fact that the financial sector could still enjoy salaries far above the average was seen as unfair. Following the controversy, the wave of salary cuts in the industry officially began. What started with a few securities firms soon spread across the entire sector, initiating a large-scale capacity reduction campaign. In August 2022, China's Ministry of Finance issued a notice restricting compensation in state-owned financial institutions. This followed the Securities Association of China's May release of the guidelines on establishing a sound remuneration system in securities firms, marking another financial industry salary cap. In February of last year, the Central Commission for Discipline Inspection published an article that criticized the financial elite mentality and the overemphasis on money, calling for a crackdown on extravagant lifestyles and the pursuit of high-end luxuries. These changes have clarified the positioning of China's financial industry, making salary reforms inevitable. Furthermore, as the economy continues to struggle, more extreme and opposing societal emotions have surfaced. In early July, a heavy mortgage burden and the declining value of her luxury property. The incident caused CICC to trend on China's social media Weibo, with many expressing regret over the tragic loss of such an accomplished woman, whom they saw as a casualty of China's real estate downturn and economic stagnation. The sudden salary cuts and the mass exodus of workers from the securities industry have inevitably bred further anxiety. A gloomy atmosphere of disappointment, frustration, and self-doubt now hangs over the entire industry. On August 30th, rumors surfaced that an employee at CICC's Shanghai office had received an email notifying them of a demotion and salary cut. The email reportedly stated that if the employee did not sign, the company would proceed with unified arrangements for the next steps. This language led to the employee to speculate whether the company's plan involved forced layoffs. A day later, the guess was confirmed. Insiders revealed that employees who did not accept the demotion and salary cut could voluntarily resign, and if they chose not to, the company would continue with other internal procedures. On August 31st, Yi Chai reported that CICC had plans for salary cuts and layoffs in the near future, with a 25% reduction in salaries and a 1/3 reduction in investment banking staff. With the era of large-scale IPOs in the A-share market over, the investment banking sector had become severely overstaffed. The mass delisting of stocks was expected to result in many retail investors losing their investments, and the outlook for stock commission income was grim. Most securities firms were projected to see their profits shrink, with smaller, weaker firms potentially being merged or forced out of the market altogether. The golden era of securities firms had essentially come to an end. Wang Guochen, a research associate at the Tsinghua Institute for Economic Research in Taipei, remarked that the concept of cutting costs and improving efficiency was inherently contradictory. He argued that Xi Jinping continues to view the current economic and financial systems through a Mao-era lens, but the idea that the state can sacrifice individual interests no longer works in capital markets. He added that if the financial industry strictly follows central government directives, there would be little room for economic breakthroughs, and in a more pessimistic scenario, it could even lead to regression.